The US debt just surpassed $35 trillion. What does this mean and why should you care? Let's get into it. So this is the national debt. As you can see, it's over $35 trillion. And how did we get here? Well, here's a chart of the debt. It's a little not up to date, but you can see that we were right around 3 trillion all the way up until 1981, and then we just skyrocketed from there. Okay, so remember 1981 because it is a significant date. And how fast are we increasing this debt? Well, the US national debt is rising by $1 trillion about every 100 days. Okay, so that's $3.5 trillion every year currently. So it's rising very quickly. So what does this $35 trillion number mean? Well, it doesn't mean much in of itself. It's more of a news headline number. What really matters is the debt to GDP ratio. Okay? And what is that? Here is a chart of the debt to GDP ratio. And the GDP is essentially the total output of the economy. Another way of looking at it is it's the total spending and it's the total income of everybody. Okay? So if the debt rises at the same rate as the GDP, it's not as big of a deal, right? Because if people's spending increases while the debt increases, it's not as big of a deal. Okay? What you are looking at is the long-term debt cycle. Okay? And where are we at right now? We're at 122% of GDP. We could start at World War II. The government spent a ton of money during World War II, so they increased their debt. And it didn't increase the productivity of the economy at all because a lot of the money that was spent went overseas and got destroyed. And then after the war, we went through a deleveraging phase all the way until, you guessed it, 1981. Remember that date. And then from 1981, we went through a leveraging up phase all the way until the pandemic, where I think we reached almost 130%. And now we are in a deleveraging phase again. That's why when you hear people say we've entered a sea change, we've entered a different era, this is what they mean. It's all about the long-term debt cycle. Okay? Now, the 130% mark is really critical. We do not want to get above 130%. When you get above 130, it doesn't end well. And here's proof of that. Since 1800, there have been 52 countries that saw a debt to GDP above 130%, and 51 of those countries have defaulted. Okay, and the only one that didn't default was Japan, and we know Japan has been in a stagnant economy the last 25 years. So we're at 122%, and where does that rank throughout the world? Well, we are fourth highest. This is a list of the G20, so essentially the 20 largest economies. And we're the fourth largest. I'll scroll down so you can look at some of the other nations. You get China at 77, Russia's all the way at the bottom, 14.9. But we're pretty high up there at 122%, okay? So where does the debt come from? What is the debt? I'll explain it to you right now. This is the monetary system, okay? And I know this looks like a lot, but I'll make it really simple. The government takes in income through taxes, and then they spend it into the economy. They spend it on, Medicare, defense, Social Security, a bunch of different items. But if they spend more than they take in, they have to issue treasury bonds, okay? And what treasury bonds are is they are IOUs to the public saying, hey, if you give me a loan of your money, I will give you this IOU and pay you back in the future with interest, okay? So that's the deficit. If they spent $100 and took in $90, then they need to issue $10 of treasury bonds to cover that $10 of overspending, okay? And this number each year is called the deficit. and then the total deficit, if you add up all the years, is the total debt. Okay? So what happens when they have to repay the debt when it expires? Well, they just issue more treasury bonds. Okay? So they have to issue the same that they had previously plus enough to cover the interest. Okay? So every year they have to they have to issue more treasuries just to cover the interest. Okay? Now, what is this deficit so far this year? It's $1.2 trillion fiscal year to date. Okay? So now you know where debt comes from. And let's go back to this chart. So how can the government deleverage? Well, they want this line to go down. So they want this equation to go down. And there's two ways to make this equation go down. You can decrease the numerator or increase the denominator. Okay? So you can either lower the debt or increase the GDP. Okay? Let's talk about the first one. How can they lower the debt? Well, to lower the debt, you lower the deficit, and in order to lower the deficit, you lower the spending. You cut spending, right? Because if you spend less, you don't need to borrow as much. This is called austerity, okay? And I will tell you right now why this will not happen. What does the government spend their money on? Here is a chart of the different categories the government spends their money on. Number 1, Social Security. This is year to date. Number 2 is just the interest. 3 is health. 4 is national defense. 5 is Medicare, income security, veterans. So a lot of things that you can't really cut spending on. You can't lower Social Security or else there's going to be a civil war or some riots in the street. If they were to cut spending, it would be on very minuscule items. Okay? So that's one reason they're not going to cut spending. Here's another. What is the net interest on the debt? So just the amount they have to issue to cover the interest on those previous debt payments. It's $1.1 trillion. And this is actually a little delayed. It's more like $1.2 trillion. Okay? Now, does that ring a bell, $1.2 trillion? That's the deficit. Okay? So the interest on the debt that they have to pay is equal to the deficit that they have spent this year. This is the deficit as a percentage of gross domestic product. And we're right at 6.2% of GDP. Okay, and see how we're below zero this whole time. So we're constantly running a deficit. If you're above zero, you have a surplus, which rarely happens. If you can just look at history here. Okay, so they're going to need to keep spending money to function. Okay, what's another way that they can lower their debt? Well, if they want to lower this, they can also increase their taxes, right? Because if they have more income, they won't need to borrow as much. Well, what's one way to increase the income? You would think at first, oh, just raise taxes, right? Well, taxes is a percentage of income. And if you raise taxes too high, people will stop investing in making business investments. They'll become less risk on. And if people have lower investments and lower incomes, the government takes in less in income. Okay, so there's a cap that you can tax on people where if you keep taxing, the actual amount of money they take in becomes lower, okay, because incomes fall. Okay, so if they can't spend less or take in more money in taxes, the only other alternative is to increase the GDP. Okay, and how can they increase the GDP? Well, remember the GDP, the nominal GDP, is the total spending in the economy. And what's one way you can get people to spend more money? Well, you can just print the money and give it to people. Okay, and you see this often during recessions. So let's look back at the monetary system. If the Federal Reserve can also buy these treasury bonds, and when they do that, they print money into existence. So typically they'll borrow money that's already in existence when they issue the treasury bonds. But if the Federal Reserve prints money, this money gets directly inputted into the economy and increases spending. Okay? Now let's look at the nominal GDP equation. Nominal GDP is the total spending like we talked about. But you have to be careful, because if you increase the spending but the productivity stays the same, the real productivity, then you'll have inflation. Okay? This is exactly what we saw after the pandemic. They increased the spending by issuing stimmy checks, yet the productivity didn't actually increase, so we saw inflation. So this is the way they deleverage. They print money and they inflate their debt away. Okay? Another way of looking at this is if you owed $10 in the year 1900, that was a lot of money. But inflation has devalued the dollar so much that $10 is nothing to us. So if you create inflation by injecting more money into the economy, it inflates prices, devalues the currency, so the debt that the government pays isn't as much money when looking at debt to GDP. Okay? So remember, if they spend more by injecting money into the economy, they have to watch out for inflation. What's one other way to fight inflation? It's raising interest rates. You are looking at the 10-year bond, really called the 10-year note, yield. Okay, so this is the interest rate on those 10-year bonds they issue. This is a very similar chart to the long-term debt chart. It's in reverse, right? So in order to deleverage, they had to increase the nominal GDP, so they had to increase the spending. They did this by injecting money into the economy. But if you inject money into the economy, it causes inflation. So the interest rate increased to fight that inflation. And it got all the way up to 16% in 1981. So what can you expect in the future? You can expect this 10-year rate to be higher for longer. Okay, so you can expect it, to come down, back up, down, up, right? Because we're in a deleveraging phase. What can you expect with higher interest rates? You expect higher inflation, more money printing, okay? Now, higher inflation doesn't just mean higher inflation in consumer prices. It also means higher asset prices because it has greater volatility that comes with it. So that's essentially where we're at. This is not my outlook short term. I actually think that rates are going to come down in the short term because I think inflation is not as big of a deal at the moment. And I think we're going to enter a recession. So I think the Federal Reserve is going to drop short-term rates, which will also drop the 10-year. But you can expect this to go back up. Okay? So that's the debt. That's where the debt comes from. That's why debt to GDP is really the more important factor. And that's why we are going back into a deleveraging era with higher inflation, higher interest rates, and higher money printing. Until next time, Godspeed.